What you're looking at right now, of course, is a 14-day free trial structure to Power Options. Those of you that are just getting started on your 14-day free trial, I encourage you to take advantage of the 4 steps that are listed. You can see that right there. You can get access to the quick start guide, review some of the flash tutorials, check out our archives or join us for a live presentation, or you can schedule a coaching session at any time as a trial member or subscriber. And that's essentially a 40 to 45 minute phone conversation with myself or Ernie or one of the other staff members. All right, well, we do have some questions that started to come in already. First question comes in from Sam. Sam's a regular here for our Friday session. Sam says, hi all to the room. Fantastic week managing risk with calls. So they get 0 when a big move in indexes. So Sam sort of goes in and out of straddle positions, gauges market direction using his charts, and he had been selling calls on some positions. I, of course, sold some positions this week on Monday and Tuesday, which can now be bought back for almost an 80% gain, and I still have 20 days to go to expiration on those positions. So Sam does sell calls and puts in between when he thinks he's bullish or bearish. Had good returns on SPY, DIA, and DX as well, but he's also long puts on some of those positions as a hedge for the rest of his portfolio, and they profited as well. And he goes on to say, SPY, DIA, and NDX puts are the winners. Got to have double the puts and then calls to profit in the bear market on us now. So yeah, we've had a couple stocks. I had a couple stocks that actually moved up in price today that I was tracking while everything else had moved down. But there weren't that many that moved up. And I currently wasn't in a hedge on an inverse ETF or on VIX calls. I closed out ones last Wednesday. I haven't bought new ones. Should have probably bought Monday or Tuesday when I was selling my calls against the stock positions in the protective strategies. Okay, question comes in from David. And David says, Mike, I've been following the radioactive trading techniques and some of your positions. How come you haven't made any adjustments to the radioactive trades in the Fusion portfolio? Okay, well, let's take a pause for a minute. And what David's referring to is that naturally the other service that we run, RadioActiveTrading.com, is involved with the blueprint ideas of using a married put structure to protect a stock position, but using a far out put to limit risk to single-digit percentages. Now, recently I'd made a couple adjustments on some of the married puts that I'm currently in, such as AMAT, as well as Interactive Brokers. Well, I should have done one on Interactive Brokers. I didn't. More's the pity. But he's asking, why have you not made any adjustments on those positions? Well, let's take a look at the AMAT listing. We'll take a different look at this at Power Options in a moment. So over time, I've made some adjustments. I've sold some calls against it. I adjusted the put once, so I'm now holding the April 60 call, which is coming up to expiration. We had an expire March 61 call on 3/16. And then on Tuesday, when the stock moved back up, we were able to sell the 6th of April 61 call for $1.53. Now, because of the increased implied volatility that happened when the market fell in the past few days, the buyback cost of this call, even though AMAT, as you can see now, the current price is at $55.38, which prompts the question, why haven't I done any adjustments? But to buy back this call is still about, last I looked, 55 to 60 cents. Okay, so I haven't made 80% on this call yet, even with the stock pulling all the way down to 55. It might have been the last half hour. I was actually recording a different presentation. But in any case, if you notice here, the liquidation value is still profitable, even though the stock has fallen roughly 5 points in the past 3 days. So when I see this call get to a buyback cost of about 80% or more, meaning I can only buy it back for maybe 25 cents or 30 cents, I'll probably close this call and roll down to a lower strike, or I'll liquidate the whole position for a profit, even though the stock is below what I originally paid for it. Not a high profit, mind you, but the stock is down. I'm still going to have a reasonable profit on the position. Now, regarding the other position, Interactive Brokers, this stock as of the other day was at 72.24, before the adjustment happened on Wednesday. You see now it's at 66.21. But I'm holding the 75 put, which is a value of about $11 right now. So if I liquidated this position, I'd get about $67 back. Why haven't I done an adjustment yet? Why haven't I adjusted the put, or why haven't I sold the call? Well, it's because of something that Sam mentioned. Sam mentioned, he says that he had a great run in this bear market over the last 3 days. Now we know there's concern out there. We know there's fear. Trade war, Fed hikes. Really, it's about the trade war, though, the impending trade war with China, and, of course, the deficit just passing, or I should say the budget just passing. And there's other things that could come out over the weekend that we just don't know. Well, my biggest fear on something such as Interactive Brokers, or AMAT, is trying to chase the sudden movement, trying to chase the surprise. If I look at AMAT now and I say, oh, well, the stock's fallen, let me buy back my 61 call and sell a 57.5 or a 56 now that the stock's dropped to 55. And then come Monday, fears are eased and the stocks move up 2 to 3 points and AMAT goes back to 58. I'm going to pay more to buy back that 56 call than I could get by selling it today. Okay? So I don't want to panic. Of course, I have the benefit of not panicking because most of my stock positions are hedged with the put. Portfolio is usually hedged with a couple VIX calls as well in the case of a sudden surprise, which Sam will chide me for because I wasn't actually in any VIX calls this week. I was waiting for a lower price to buy in, and then by Wednesday, throw that all out of the water, Wednesday and Thursday. So, long story short, why haven't I made any adjustments yet? Because I'm not sure that we're going to see a continued deflation. Even if the stocks settle on Monday and stay right on the 66 to 67 range, that'll give us a lesser volatility for adjusting the positions, for buying a new put, for adjusting in that fashion. Sure, what I should have done, I'll be honest with you, is on Tuesday when Interactive Brokers was at 72.25, I think I could have gotten $1.60 for the April 75 call. Let's just take a look. So I'm going to go back to power options, and we're going to take a look at the chain. I'm going to go back historically. I believe it was March 21st or March 20th. I'll try the 21st. Yeah, 72.22. The April 75 call was about $1.50. During the day, it was about $1.60. Of course, where is it today? Looking historically, let me go to current on our chain. And you see here, it's at 20 to 50 cents. So that one would have come close to where I could buy it back now, realize most of that profit on that short call, and I still might be able to sell a 70 call, roll it down for extra premium. But I didn't sell the call initially. Why? Because everything looked good. The stock was at 72.25. It had been moving up consistently. I didn't see anything on the horizon that would cause me to think that the stock would fall, but then something did happen, the unexpected. Well, again, it's protected by the 75 put. So I can't lose more than 2 to 3%. Right now, with increased implied volatility, even though the stock is currently at 66.21, I'm only at a loss of less than 1% on the position. Adjustments will be made, and adjustments will go forward as well in that case. But that's why I haven't made any adjustments on those positions at this time. We might take a look at those later, or examples of other married puts later as well. Sam goes on to say with the technique he's been using so far, following his trends, we've talked about those a couple times. I believe it was last week or the week before we looked at the stock chart. We talked about MACD. It was about 4 weeks ago, Sam, when we shared some of your images. But in any case, Sam owns some stock from time to time. I don't think he's been in some of these stocks. He was doing LFN earlier today, but I think he was just using puts and calls on LFIN. But he shares the comment that his portfolio is up 60% so far in 2018. Well, I'm less than half of that, but I'm also so far right now exceeding with the different strategies I trade what I made last year because I put more into different positions. All right. Mohammed says, when do you close a VIX call? I had a VIX call for a strike price of 19 for the March 21st expiration Wednesday. So I probably didn't know what I was doing. I thought when the Fed hikes, with the Fed hikes, it would have raised the VIX. And it did a little bit, but there's not a trick. There's multiple tricks to the VIX options, which can be very tricky. So let's take a look. Now, back on, was it the 18th, or you said the 21st. Let's go to the chain here. Oh, the expiration we had on the 21st. Let's go back to March 1st, for example. Well, no, let's not go back that far. Let's go back to the 16th. Standard Friday expiration. But we would have had the 21st available and the 14th. They expire on Wednesday. That's the trick. So let's just go multiple days forward. On the 16th, standard expiration a week ago, last Friday, the VIX was at 1580. Let's say I bought an out-of-the-money March 21st 18 strike. We'll go right at the ask for 50 cents, okay? 18 at 50. Okay, now what happened the next few days? On Monday, the 19th, we're up 322. The 18 calls are at about $1, 95 to 105. So that's about 100% gain. Now, in General Mohammed, I will treat these like a normal long call. I would have a target in place for them to hedge my portfolio. We know that if the VIX moved up here, there was some kind of fear or something that happened between Friday and Monday. And I'm not saying I could have paid exactly 50 cents for the VIX calls on Friday. It might have been higher during the day. It might have been a little bit lower. But on day one, we're at 100% profit on those positions. Depending on how many calls you had and what was the reason behind the movement, that might be a good time to close it, take the profit, and then maybe you could try to go further out in time for other out-of-the-money options if you could get 50 cents. But now the bid-ask spreads got really wide. But let's go forward another day. So we were at 1902. Now it pulled back. Okay, so now you're still at a reasonable profit on the position. Now this is a tough one because we're on Tuesday, March 20th. These expire the 21st, and they expire in the morning, I believe. Okay, so the last time to trade it would have been Tuesday night. If you didn't take the profit then, you should have taken the profit here, okay, for the 18 calls. I know these aren't the calls that you're in. I'm just saying as an example. And then, of course, we go a day forward, and they're gone, right? On March 21st, they're gone. So we're looking out here. If we had rolled them out to get a different calls, we see the bid-ask spreads have settled down a little bit more, but they're really not that wide further out in time, but they're still pretty wide for the next week out. 2 weeks out, April 4th. My apologies. All right, so let's go forward a day. Now, there's the big day, unfortunately, but we've already missed the boat. Our VIX calls have already gone. And now begs the question, of course, let's go back. Let's go back a couple weeks. I don't want to go that far back. Let's go to the 9th, Friday the 9th. See, the VIX was at 1464. So here, yeah, for the 21st, sorry, the 18th still would have been 70 to 80 cents. So if we didn't get a profit here, remember, so on March 9th, we buy those 21 VIX 18 out of the money calls for 75 cents or so. When we hit 105 on Monday, we're only looking at about 40-45% return. We're not at that 100%. But the next day before expiration, we still had some profit, so I would have closed them then. Okay, if you didn't close them before. And it's unlikely the way the VIX was that you might have had a profit before that time, although you might have had it on the 15th or the 14th. Let's take a look there. Let's go into the next week of expiration. So let's just go to Monday. We'll go day by day. Why not? So we paid 75 cents for the 18. Here we're almost at about a 60% loss because it's down to 20 cents. That would have been a good buy period for those VIX calls. And then they're at 10 or, oh, that's 314, I'm sorry. Now we're at 95 or $1. So now we're looking at a decent profit on the 13th. 21's now at 105, 110. Okay, so we're still looking at a decent profit, but we're not at 100%. I don't know if we reached that on the 15th. Nope, still 70, 75, right even to the price. Okay, so there's a chance that you might not be able to see a profit on your VIX calls. In this case, again, even though if I bought these on March 9th, the out-of-the-money 18 calls at 75 cents. On the 19th, we saw we probably could have closed them for about $1 or so right here. It would have given us a small profit. We would have rolled probably further out to the 28th. I usually do mine on a monthly. I usually try to go the Wednesday of standard expiration, and then if I haven't made my profit yet, I'll roll them. Same way I might treat a long call, but I usually don't hold a long call that close to expiration. VIX is a little bit different, okay? And, you know, Sam kind of mentions that he's had a tremendous run in UVXY, which is that ETF there that tracks it. He just commented here while we were talking. He says that he feels it may be hitting 30 again next week. If it's not there, if it's not ready, he might buy the other puts there as well. Okay, so that's another idea. Go ahead. And he thought, okay, Mohammed did say he thought of closing it when Facebook dropped. That did bring up a little bit. That did bring the volatility up a little bit, of course, when Facebook dropped. But we were getting so close to expiration. As I mentioned, when I had paid 75 cents from it, if I'm within 2 days to expiration and I can get 30 to 40% profit on them, I may have closed out here and then look to roll out another month or so to cut down the costs on the next one, taking some profit on them, realizing that a lot of times I may lose a fair amount of money on the VIX calls as a hedge. Sometimes they'll just dissipate. Now, Sam had mentioned his projection, of course, that it might move up higher to the 30 range. If UVXY goes up to 30, the VIX will go up as well. And we'll see that soon coming up. Sam mentioned he did buy stocks today. He bought in a nugget. Yeah, I was looking at the GLD options also today. Gold becoming a slight safe haven when everyone's in a panic as well. So we might see that there. Okay. Now, James wants to take us back to the radioactive trading techniques. He has one on stock HPE, some married put position. So let's just go, now let's go to the custom spread tool here. We'll build the position and take a look at where he's at. It's at a loss, and he wants to close out the position because he doesn't think HPE is going anywhere. So an adjustment would be good, but I don't think it could be adjusted better than closing it. Stock price for HPE was $18.95 per share. And on February 28th, about a month ago, he bought the August 17 put for $1.98. Problem here, James, you don't tell me which put you bought. I don't know if you have the 18 or the 19 or the 20, which is kind of relevant there. So if you could let me know which put you bought, the strike, just chime in on there with the question pod, James, so I can take a better look at it as well. Whoops, sorry. All right. Oh, follow up to Mohammed real quick. Oh, it's the 20 strike. Okay, so we're going to go to the 20 strike at 198. So it's lost some value for time. Oops. Here we go. That'll help. Let's get this right. Okay, so it's worth, you bought it at 198. It's increased, I'm sorry, to 266. You got about a 60-cent gain there. Hewlett-Packard's down to 1763. So you've got 2093 invested. It's only a 4.4% risk. Okay. But sorry, I wanted to go back. Mohammed asks, is VIX European or American? I got confused if I can close it at any time. Yes, you can sell to close your VIX options at any time. Okay, you should be able to do that without any problem on that as well. Okay, all right. So here's our position on Hewlett-Packard. You don't think that you think the stock's going to stagnate. You're worried about losing money, or you're worried about just not seeing any gain, I should say, in the position to get to a profit. Well, as we saw, the rough close of this is now at about 266. So if you sold the stock at 1763 and sold the August 20 put for about 266, you're going to get about $20.29 back. Your cost basis was only $20.93. Okay, so it's about a 70-cent loss right now. Let's call it 60. So it's only going to be about 2/3 of the max loss you're willing to take on the position. All right, now, is there anything coming up? Let's take a look. First thing I need to know, I'm going to go to the stock research tool here, James, before even looking at the position. Unconfirmed, we should expect earnings around May 31st. That's still 2 months away, roughly. And that's important because if I'm thinking of I'd need a catalyst for this to move, it's probably going to be around earnings. So even if I make an adjustment, I might not want to come in closer than this. Okay, I might want to stay in June if it's available, which it might not be because of the cycle. So let's see what we've got available here. I've got a May and I've got an August. Okay, Junes are not available yet. One thing I might consider doing is selling the August now at 198. You might be able to buy a June 20 for only $1.68, $1.58 hopefully. So you'd get technically 30 to 40 cents on the position. Oh, I'm sorry, you'd sell it for $2.66. The June might only be worth $2.24, $2.35. So you might get 40 to 30 cents, which might lower the risk significantly. It might cut it in half if we could move it in. I don't want to go to May. May would do it too. All right, so if I sold the 20 put for May, or for August, and again, we're talking, oh, it's a little bit more. It was about $2.70 we're going to get for that if we get midpoint. I buy the $2 one, we might get $2.25. So we'd get 50 cents in, so our risk would drop by about half by just rolling it into May. But now I'm not covered through the earnings. Okay, it's only down to 2% now, or $41 for that position. And I can't sell a call right away. I don't want to risk selling a lower strike call, say at the 18 strike or the 1850, because if the stock recovers and moves back up, I might be at a loss. Let's see what that would look like. We rolled into the 20 put, and I never want to sell a call below the put strike price. But now that I've moved it in, cut the cost basis, if you did sell the 14-day out, 18 call, simple income method number 1, no, that's not going to cut it for us. Now we take a risk to the upside if the stock moves back up. I don't like it. I don't like this chart. It's all red. There's no point to it. Okay? Now, the problem with making this adjustment is that although you lowered your risk, you also cut your time by more than half. And the new put option is going to expire before the earnings, which might be a catalyst to push it forward. So, you think the stock's going to stagnate. Now, you could roll down. And it's tough to do that because it's going to increase your risk, but you have a low risk to begin with. But if I maybe want to try to take shorter term profits on a position to be a profitable view, maybe able to take some profit out of our August put that's gained. Let's roll it down to the 18. Okay, so sell to close this, take that 70 cents of profit we made on the position roughly, pay another $1.40 into the 18 strike. Now this is going to increase our risk on the position. It's going to double it to 8.5%. But let's see what happens here. What have we also done? We lowered our cost basis to 1967. So now if I go out to April, I have to go out to standard April expiration. Those premiums were nothing. Those premiums are still nothing. But maybe if I sold the 19 strike, which you wouldn't do, you'd want more premium. I could go out to May too, but that's a long term. See, what did this do? Even though you only got 14 or 15 cents, if the stock goes up to 19, which you're not expecting, I know, but it'd be a 1.5% gain after moving down the put, lowering the cost basis, and generating another premium. But I really want this to be much higher. The premium of the call you sell should always represent 1/3 to 1/2 of the total at risk. We're hampered by this because we don't want to sell the 18, because if it recovers and breaks through it, well, we might be in trouble. You might have to buy back more. So you could take on extra risk and lower your cost basis, which means you'd be able to get profitable faster if the stock does recover. You could roll it into May and cut your cost basis in half. But now you're only protected for 75 to 80 days and you won't cross the earnings. But again, long story short, see, this is rolling down to the 18. Let me go back to May for us real quick there. And keeping the 20, remind you, not rolling it down, but keeping the 20. Wow. I'll buy that, James. I'm sorry. This does lower your risk by half down to 41 cents. But remember what we looked at. If you close it right now and get the midpoint, 277 and 1763, we're at roughly 2030 on the position. If you liquidated right now, you're going to be at, actually, you're going to be at 2040. I'm sorry, 2040 on the position. And your original cost basis was 2093. Okay, so you're taking a 53-cent loss, which might push this up to 3%. No one likes to lose, but if you don't have any expectation of this stock recovering or moving anytime soon, if you're fearing that it's going to stagnate for an extended period of time, rolling it down, making an adjustment might lower the risk. We saw rolling into the May put, the 20 put might lower the risk, but now you only have 60 days. You're almost guaranteed that 2% loss at 41 cents. But your risk would be lower, even lower than liquidating right now. But then you're still sitting on sort of dead weight for a while, right? You're or dead position. It's not moving. You'd still want it to move up. Could you try to milk it with the other income methods? Maybe. But again, anytime you're selling a call, whether it's with just income method number 1, income method number 6, the spread trade, where you're still selling a call but using a spread trade to leave the upside open, or any of the other income methods that use a spread by selling a call, 5 or even 8 perhaps, you can't sell a call below the put strike price because it'll probably put you into a negative range. If the stock moves back up to 18 or 1850, you could be at a loss, where by doing nothing you might have been at a gain. Okay, so from time to time there's nothing wrong with just closing the position. You could roll the put closer. You could probably roll the put into April and get a lower risk too. Let's just look at that. So I think it's going to stagnate. Right now we are at a loss if we liquidate of about 53 cents. If I keep the same put strike but roll into April, which only has 28 days to expiration now, we're going to take some more money off the table, about 52 cents or so. So the most we could lose in April now is only $40. But now, because we only have 28 days with the stock at 1763, we're kind of getting ourselves a 75-80% chance without a catalyst that we're going to take the $40 loss, lose 2%. But it's not 4%. It's $40, not the $53 if we liquidated right now. And if something unexpected does happen in the next 28 days, we might even be able to see a profit, or you might even be able to sell a weekly call against it, but not until the stock goes back up to 20. Okay, so that's kind of what I'm thinking there as well. All right, so Sam says after 3 p.m. I bought 10 puts in SPY. Was at 1061. He sold them before the market closed at 258. So he's doing some quick day hedge trimming there as well, or hedging there as well, that turned into a little play. Oh, and in my comment earlier about not knowing what to expect on Monday, comment came in that says SPX is holding the 200-day moving average. If it breaks the 200 MA, we're probably in big trouble, so expect the bounce. And we might see that Monday, or we might not. Yeah, and Sam says in relation to his positions, he, sorry, in relation to his positions as well, the SPX trade he did today with the puts, he says, yeah, it was a very fantastic trade, the 10 puts on SPY from 261 to 258 in the last hour. But he had to be on top of it. Many of us probably didn't want to watch the screens for that last hour, trying to make sure we don't take a loss on those 10 puts, or too big of a loss on those 10 puts if it started to recover, and trying to get out the right prices. Mohammed mentioned earlier with the VIX calls heading into expiration. Okay, stick with the married puts for a moment. All right, and this is a webinar that's available for Blueprint owners and for RadioActive traders. I'll show you here. So RadioActive Trading, and we'll take a look at this in a moment too. I want to describe some of the benefits of it. But RadioActive Trading is a method. No, I didn't want to go there. I'm sorry, folks. Is a trading strategy that is capital intensive. We're using a married put combination to limit risks to only single-digit percents. But we're buying stock and buying a put. And as you saw with that first chart on HPE than we looked at for James, his position that has moved down against him. It is a bullish strategy. Has a similar risk-reward profile to a long call, of course, but they're not parity trades. I might get to that in a moment too. But Blueprint owners and Fusion subscribers, they sort of have access to members-only webinars here, and one of them here is playing the bear side of the market. Okay, what is that in relation to? Well, Mark's question that just came in, he says, could you review the general preferred bearish radioactive trade in comparison to the standard bullish trade of own stock and long protective put? Well, my preference, and again, I'm not saying we're bearish yet, Mark. I'm the same reasons that I mentioned to David earlier that I didn't adjust IBKR and AMAT with a recent decline is because I'm not trying to do a knee-jerk reaction and overtrade based on this. If I had a position in place before the last 2 days or traded actively today as Sam did, I could have grabbed extra profits or done an adjustment. But trying to adjust a position immediately after what happened on Thursday would have been difficult because of the increased implied volatility. So I'm waiting to see what the confirmed trend is. Just as Sam mentioned, are we going to drop below the 200-day MA? What is the MACD signal as a confirmation going to show me on Monday based on what the market does? I have to wait. I know what it looks like now, but I'm not convinced. Everyone will digest the information and will either be in a worse situation on Monday or, hey, it's calmed down a little bit and the fears have eroded. But to your question directly, mainly two approaches to playing a bull put, a married put and inverse. There's technically three, but I ignore one of them. Okay, I don't use one of them. That's not to say it's a bad play. So let's go back in time, very, very briefly. I'm going to go back to IBKR, and we're going to go to the chain. And I'm going to go back, and either one of these positions is going to look phenomenal. Okay, but I'm going to go back to the 19th, or was it the 20th? I'm going to cherry pick. All right, I'm going to go, I thought it was at 72. Is it the 21st that it was? Yeah, okay, we're going to go to the 21st. I'm sorry, Mark. And I know just because it's a position that I trade, I could use AMAT as well, but I'm just going to use Interactive Brokers. This only has monthly expirations, does not have weeklies. Okay, just standard as well. Now, on March 21st, if I was going to open a married put for IBKR, I likely would have bought the stock, of course, let's call it 72.25, nice round number. But then at the same time, oops, sorry folks, I hate when that does that. At the same time, I would have had to go out to September, 184 days away. I probably would have bought the 75 looking at the numbers. It's close, but we're going to buy IBKR at 72.25. And let's say I paid $7.05 for the September 75 strike. Okay. Now, this is essentially just half a strike in the money. That's going to be important for a moment. I'm not worried about delta. I'm not worried about probability. Just eyeing this, I'm concerned about the risk. That's my main focus. So let's build what the married put would have been. 100 shares of stock, 72.25. Bought the September, slightly in the money, 75 put for a cost of $7.05 at midpoint. Yeah, this is what I would have done. So my investment is $79.30 into the position. It is capital intensive, but because I own the stock and the put against it as an insurance, I'm only risking 5.4%. Okay, now that's bullish. That is a bullish position. I need the stock to move up. If I open this position, it's because I expected IBKR to continue to move up maybe 5 to 8%. Really about 3 to 6% in the next 30 days. Okay, that would have been my outlook and why I opened this position. But now we fear that we're in a bearish market. Okay, rather than do this, the natural question I get is, can I do the opposite? Could I have shorted 100 shares of stock at 72.25. Oh, let me go to the chain. And bought the 70 call, half strike in the money, for 765. Oops, sorry. Well, you could have, okay? And this would have been on the 21st, 70 call, 765. Okay, now that lowers the short to 64.60. Because of the cost there, you're risking 8.4%. This one was kind of inflated here. The call was kind of, the stock was at 72.25. Did I put that in right? Yeah. The 70 call is a little bit more inflated there, so we paid 765 for it. We saw at midpoint as opposed to the 705 we paid for the put, which was almost the same half strike out of the money. Okay, but in any case, you have an 8.4% risk. This is the reverse of a married put. It's called a married call. Mark, I don't do this personally. Number one, it's because of shorting the stock. First off, most of my radioactive trading is done in an IRA account, so they don't actually let me short stock in that account. I do have a cash account, another broker. I could if I wanted to, but I usually choose not to. I play bearish things different ways. But also because most of the time, if you short the stock, you're sort of borrowing shares from your broker. I know prices have gotten better, but that means that on a monthly basis, you're getting charged a borrowing fee or a margin fee for the short stock position. Why is that an issue? Because it's taking away from this, which means it's adding to the risk on a monthly basis. Stay in it for 2 months, you'll have 2 fees. Some can be high, some are not that high, but it's going to add to the risk on your position. Okay, so in light of that, what's the idea? How do we mimic this? Well, remember how I've always said that a long call is not a parity to the married put trade. They have the same risk-reward profile, but you're risking 100% of what you invest in the call. A parity trade to the married put I had set up, if I was bullish, would have been to buy the September 75 call at midpoint here at 505, which would have been similar to the risk I was taking with the married put, but then leaving $7,200 on hold in my account that I did not use. So now, out of the $7,800 I invested, I could only lose 505 against that I'm not touching for any other strategy. Now we can say that the long call is at parity because you're putting the $7,000 aside, not risking it in other positions. We're both risking about 505 total of 7,900, 7,700 allocated to the position. That's a parity. Buying the call by itself is not. We'll talk about that more in a moment. Now, that's not what you want, Mark. You want the other direction. Okay? So instead of doing the married call, maybe you just buy the put at 465. Look at that. If you shorted the stock on March 21st at 72.25, that September 70 call would have cost 765, and that's still a risk of 540 or 8.4%. On the same day, the 70 strike put was only priced at 465. So in that case, what could I have done? Was I looking at, I'm sorry, maybe I'm looking at the wrong month. No, I'm looking at September. It's mispriced because the stock had a really good bull run. So the 70 put was only trading at 465 at midpoint. But I'm still risking 100% just like I am in the long call. So what would I do here? I would have bought the put to mimic the married call, but to make sure I'm only risking single digits, I would have put aside $7,225 in my account on the stock. So if I'm wrong and the stock moved up, I wouldn't have bought the stock. I'm saying I would have left it aside. But if I'm wrong and the stock started to move up, of the $7,600, $7,700 I invested, the most I could lose is $465. Okay, so that's how one way I could do it, that I would buy the put, but leave the money aside that I would use to buy the stock, so I'm not running into the risk of overtrading the position. In general, this would have worked out really well. We just saw that. Okay, so today, could have sold that September 70 put for $765. So you'd have made $3, 75%, 70% return on this position if you caught it at the right time at the high. Now, I typically don't do that, okay? Even though we've had some big decline recently, we've seen the big decline there also recently, and volatility is up now too, which Sam just pointed out. You know, he's saying that volatility is up. One has to sell calls in the money on the market so we can get the good call premium. Well, yeah, but you've also got to be careful of where you sell against what you own. If it continues to fall, that's great for the call, but if it reverses, you either have to buy it back for more. But yeah, we want to sell into high volatility, but remember why there is high volatility. It could continue to go the down direction, or it could recover and move back up, and then we have to do other adjustments. That's just anything. Any options trade is a give and take. Okay, so that's the other bearish way, Mark. That's in that webinar there, is Blueprint owners and Fusion subscribers to see. I don't do the married call. This is an alternative. This is not what I do either. Okay, what I prefer to do is if I think I'm scared or I think the market has turned, and in this case why haven't I done it yet? Because I'm not sure it's going to stay that way. But let me go to SH. Okay, and if I was afraid that we had had a large bullish run and the market was going to fall, if I timed it right, maybe on March 21st, what I would have done is bought shares of SH, the inverse S&P 500 ETF at $29.55, and knowing what the volatility is, that the volatility is pretty low. Here I'm probably going out to November. What's August? 120 days. Okay, I might have bought August, right on the cusp of 150 days. Yeah, and I'm probably going with a 30 at 135 at midpoint. So we're just going to say we got midpoint. 29.55, buying the 30 put at 155, right? I'm sorry, 135. So what is this? This is a married put where I don't have to think backwards. I'm buying a stock and the put, everything I've learned in the blueprint, that I want the stock to move up. I'm doing the same married put structure, but I'm doing it on an inverse ETF. So now, as the stock moves up, did I do the August? I did. I did the August 31 at 130. Somebody tell me where my numbers are wrong. That's not right at all. How did I just miss that? August? Oh, it wasn't the 31. It was the 30 at 135. That's why. Okay, let's get this right. Bought the August 30 at 135, which has lost half of its value, but that's good because that means the stock has moved up more. I didn't have a bulletproof position to begin with. There you go. A risk of 2.9%, which is what you expect with these low volatility ETFs. Break even at 30.90. In the last 2 days, the stock is over it. So this is a married put where I could potentially just do one simple adjustment now, roll up to the 32 put. Remember, we only had a risk of 2.9%. All right, so now I've used income method number 4 after 2 days, have a risk of only 0.6% with a 32 strike. And I'll go to April. Let's go ahead and do that just as an income method number 1. Bulletproof in 2 days, max profit 5.3%, no chance to lose in either direction. There's double ETFs you can play as well, but the price for the put would have been inflated on that. Okay? Now, all that being said, those are the 2 ways I play. If I'm already in a married put to begin with, such as with IBKR, and this is not my actual position, I'm going to grab that for you in a moment, but let's take a look at the custom spread tool, the profit and loss chart. This was my original position on Interactive Brokers. Stock purchase at 67.72, 70 put at 720, and the stock had moved up. Now, let me go back to RadioActive Trading. Let me look at the open trades here for Fusion on Interactive Brokers. Last trade March 9th. When the stock was at 72.40, higher than it was the other day. But I rolled, using income method number 4, I rolled the put up 5 points. I paid a debit to do this, but it was only a debit of $240 to gain $5. That's the advantage of income method number 4. So 480 to 720. Oop. Now what's interesting about this, though, is I paid 720 for the original. When I made this adjustment, the stock had moved up from my price of $67.72. We were able to sell this put at 480. You say, oh, well, you're taking a loss of 240. That's right. But I'm buying, that was already factored into my risk. Technically, I'm paying a debit of 240 to move up the put, but I'm getting 5 points higher profit. Okay, so now I'm at a position where I cut my risk in half from 6.6% down to 3% and still have the put out to September. Now, as I'm in this position, didn't know a bearish move was going to come so quickly. Yes, we've had 2 days of it. But if you caught it early, what I could have done on March 21st for IBKR, all right, 75 put was at 535. So what I could have done is income method number 12. If I was expecting a bearish move, and now, yes, I've increased my cost basis in the position, but I've got a synthetic straddle, technically, that's in the profit zone. I could close both of those puts now for about $10, move the put down to 70, and I might be bulletproof. Okay, let's do that. Real quick, let me pull up the calculator tool. Now, I rolled up originally to 720. All of my other prices are factored in. So, I'm sorry, we bought one at 720. And if I caught it at the right time, which I didn't, I'll admit, I was going to sell a call instead, which I should have done, as Sam was saying, you know, that it got reached up to 72.25. Had I anticipated a bear move, I should have bought an extra put and sold the call on this position. Would have done really well. Anyway, 1255 total into those 2 puts. So let's call it 628. So now let me add another trade line. Oh, no, I'm sorry. Let's change this that we bought 2 at an average cost basis of 628, factoring in the 2 puts. Now, what if I sell 2 of my 75 puts? What am I left with? I'm left with a long stock that has a cost basis of 60.78. Remember, I paid 67.72 initially. It's at 66.21. Closing out these 2 puts at 10.95 after this decline, we've got a cost basis of 60.78. And let's say I go back to September. I want to buy the 70s. The 65s at 5. Yeah, let's do that. 525. I'll just buy 1 now, right? Because I'm still doing 100. If I had bought the extra one, took the profit off of it, and now just wrote back to a married put, okay, my risk is 1.6% on the position. And I'm at a profit. On a stock I paid 67.72 for, the stock's at 66.21. Okay, the most I could lose is 1.6%. So this doubling to create the strangle, income method number 12, if you're anticipating a bear move and already have a position open, can be very lucrative. The position I am in right now is on Sony, like this. Sorry, back to RadioActive Trading. It shows bulletproof. That's it. Right now, I could liquidate for about a 12% gain because I have 2 puts at the 50 strike and the stock's at 47.89. My cost basis is 49.75 for the stock plus this cost, but as it continues down, these 250 puts are giving me positive delta against the decline of the stock itself. So that's an income method number 12 position I'm in. Okay, that can be useful if you're already in a married put if your timing's right. Now, if your timing's wrong, of course, then you're in trouble. I don't want to say in trouble, but you have to manage it as well, and Sony's coming to a point where I have to manage it. I already mentioned the brief comment from Sam that when the volatility is up, one has to sell calls. We still have 2 weeks to go for expiration. when the market is up, sell the put to get the put premium that you spend. So he's rolling in shorts back and forth based again on the market movement as well. And a follow-up, Sam says it is better to buy puts than shorting the stocks because too much of capital involved to cover your shorts. Right. And one could buy more contracts with the same capital. Now, Sam, that's true. And that's not an argument, but a discussion I was having with someone on an old presentation that Kurt did on YouTube, who looked at one of Kurt's married put videos and said this is a waste of time. You do so much better buying the call options outright, and you can buy more because you have less capital. We touched upon this last week, and that's why I asked that poll of everyone during last week's webinar about what would your stop be. If you were just buying a call or buying a put position, what would you use as a stop? And would you put a 25% stop on a call, 35% stop, 50% stop, and so forth? And the reason why I was asking that is because here's a married put portfolio. I'm going to show you right here. I think we touched upon this last week, but I'm going to show it again. Sorry it's taking so long to load. They're working on right now. I know in the background we're updating today's closed data. That usually happens between 4:45 and 5:30, so it slows things down. Wow, this is good. Even with the decline over the last week, and even with the hit in February that we took, these positions are mostly down. No adjustments have been made. What this is I went into the married put search, used the default RadioActive Trading criteria to find positions that matched. And what I did is I opened them every 2 weeks from the beginning. So on January 2nd, Twitter and TAL were open because they were the first two on the married put search. SS&C, and they're in alphabetical order, not date, and Integris were the next two. And then on January 20th, was it? January 16th. Maybe I was going 14 days out. There should be 120 in here somewhere. But in any case, then we went to 2-2. The first, oh no, it's every 14 days. So January 2nd, open 2 positions. January 16th, open 2 positions. February 2nd, open 2 positions. Grubhub and Planet Fitness. February 20th, 14 days later. March 5th, and I didn't do March 16th because we were just coming up to the expiration there. But even with the 2 big declines that we've seen, this is just these positions, no income methods, no rolling, no income method number 1s. There are some losses there, but the portfolio is up 5.3%. Okay, now, to be fair, what if I did the out-of-the-money long call position? Instead, open the same exact trades using less monetary value, and this isn't right because I would have bought more contracts. I'm going to get that adjusted. But okay, we look at this and say, well, this is up 22%. So right away, Mike, you've just disproved your point. Out-of-the-money long options on the same stock entered at the same time using the natural ask price for the put and for the call, this is outperforming it greatly. Well, the problem is all of the positions that were opened on January 2nd, January 16th, February 2nd, February 16th were all closed, would have all been closed at between a 40 and 50% loss on February 5th to February 8th. This 298% return on Grubhub did not exist. Why? Because in a real long call portfolio, a loss of 40 or 50% would have triggered the close. And on February 5th to February 8th, a few days after it was open, this long call hit about a 45% loss. It would have been closed. So when you factor in the closing prices of what you would have exited, this portfolio is actually down 23% loss because all these positions that you opened hit that trigger. And by the way, it wasn't PayPal. I think it was one of these two that were open on 3/5 were also closed for a 42% loss. One of these positions would have actually taken a 68% loss because it didn't hit the 40% trigger or even 35% trigger, and the next day it opened up down 68%. So of the 10 positions that were opened, 7 of them were closed prior to a loss. And right now with this decline, the remaining 3 that were opened on 220 and 35 are all at a loss. During those times when these were at 40 and 50% losses on the leveraged long call, the married puts were only down 2%, 1.8%. You wouldn't have closed it then. You could have stayed in it to realize more. Okay? So in reality, although the lady's comment, Julie, on the RadioActive Trading webinar on YouTube that I was conversing with, and I'm putting this together for her and for many others, yes, you could enter more positions. Yes, you could take a $10,000 even or $5,000 portfolio and have opened these 10 positions. These contract sizes are going to be different, which is really going to hurt the portfolio more because of the leverage when you set your loss target. These all, most of these would have been stopped out. We already showed that. They're not parity trades because you're looking at a loss of 23% with a married put portfolio still up 5%. If you'd stayed in, sure, the monetary gain is a little higher, and it would have cost $60,000. I'm sorry. I would have used $60,000 portfolio for these positions, and we're up 3,200. Okay? And the long call, as you can say, well, if you stayed in it and did nothing and ignored potential stops, you'd be at 22% profit or $8,000. So that's naturally better. But you would not have stayed in 70% of these positions. You would have stopped. It would have hit your target. You would have been closed out. That's the issue. Okay, that's the real world issue. Plus, there would have been more contracts here. Well, 350. Yeah, with 15,000, I probably would have had 2 of these that were closed out. Yeah, I would have only had 1 of Grubhub to keep this between 1 or 2%. I would have had 4 of NYT, which you can see right now is a 50% loss. We would have had 4 contracts there, not 255 cost. It would have been $1,000. Still not that high, but we would have lost 500, right? On that. And that's killing the leverage. That's the lie of leverage in actuality. But I'm not done yet. Why am I not done yet? Because this is what it would be if you stayed in. I already mentioned you wouldn't. This one I haven't filled out all the way yet, I don't think. I'm working on it. Oh, there it is. Right now it's at a loss of 10.1%. This is taking into account if you close those other long calls when they did hit their 40% loss range. But I'm also going to do different ones. If you set your target for the stop on a long option at 35%, you would have closed out of all 10 positions right now and been at close to a 40% loss. If you set it at 50, you're still at this 10% loss on the portfolio. Haven't closed out these last 3 yet, although you did. No, PayPal I think was the one that did drop 50% a few days after it was opened on 3.5, not related to anything we saw in the last week as well. Okay. So, and then of course, what am I going to compare it to also? The in-the-money long strangle, which is asked. But in real-world trading, I wouldn't have closed any of those married puts because they never got to a loss during that February 5th to 8th decline of greater than 2%, which is only 1/3 of the maximum risk I was taking on the position. It puts me in control. Biggest one now is the 7% losses on PayPal, and I just saw one up there. New York Times, NYT, which is down to 23.10. Okay, so that's, oh, I'm sorry, the maximum loss. It's only, I'm sorry, here, it's only a 3.8% loss. Still be in it. All of these are at a gain, except for that one. TD Ameritrade's at a 1.2% loss. Okay, this is what we talk about with the lie of leverage. Is it capital intensive for the married put? Absolutely. But again, it puts you in control. And you don't have to worry about volatility increases, bid-ask spreads of a wide event where you're closing out more calls and these surprises. And all of this analysis that was done, all of those positions that were closed for 40 or 50% loss were before the last 3 days. Because I didn't open any positions on 320. I stopped the test. I stopped the performance at 3.5. The positions I would have opened on March 5th. So again, that's the comparison. Capital intensive, I agree, but you're in control. Let's see, what's the biggest stock that's down? 8.5% for New York Times. If we had bought it following the trade that came in, and the max loss if we liquidated right now is only $110 or 3.8% of what I have invested. Not 38%, not 58%, 3.8%. Okay. All right. So comment, Will says, with Fed raising interest rates, when shall we start to see Rho becoming a factor to set up a married put RPM with a long-term put? I don't think you will. I know your fear about that the Rho is going to change and affect the position, but Rho is more likely going to affect someone who's doing a diagonal calendar spread, calendar call, or calendar put, where they're buying a far out call and selling a near-term call against it. Because usually in those situations, you look for a certain gamma or delta or theta ratio between the two options. Maybe an implied volatility ratio, of course, as well. If Rho starts to shift on the further out options, that's going to also affect the other ratios potentially on the diagonal spread. Interest rates increasing and the Rho moving still are not going to affect the long-term puts that much, I don't think. I'm almost positive they won't, because they didn't the last time this was done, 6 or 7 years ago, or more than that, I'm sorry, 10 to 12 years ago. It can have an effect, Will, but it's not going, you're still going to be able to easily find positions that are neutral to bullish, that have been neutral to bullish. There's Grubhub again, even though it's dropped in price, that still have, sorry, this weird, still have lower risks. Now, I'll see. My average, when I change my criteria, Will, is usually 12 to 15 married puts that match. What do I change? I have to change my stock price for what I can afford. I also usually increase my average stock volume to 750. So see stocks that trade 750,000 shares on average. Just on general principle, I've been keeping it around 8. Usually I'm between 7.5% to 8%. I don't want a risk greater than 7.5% to 8%. So we'll use 7.8. Let me go ahead and run this. Okay, so I have 10. So I'm still in a reasonable number of positions that match the risk threshold I want on stocks that I would commonly select. Look, HPE is in there again. We talked about that earlier for James. I'm just curious. I want to take a look at the big charts there. Ooh, don't like that, James. Don't like that at all. Looking at this now, there's the confirmation. It dropped, tried to go above the 20-day moving average, and then it fell. Confirmation of a MACD signal. It hasn't fallen below the lower Bollinger Band yet. Oh, it did close below it. Yeah, Monday's going to be interesting. This stock is going to be dependent on what the market does. If the market opens up on Monday, you might be back to 18 or 18.20. So you might be able to evaluate that rolling down then to maybe the 18 strike or the 19 strike, and still might look pretty good, but the prices will have changed. That's a little bit concerning that it's dropped below the lower Bollinger Band. It's brought down. The RSI has also gone negative, and I don't like where this is headed either, but the confirmation signal is here. But for me, that's not, Sam and I talked, although it crossed the MACD, it hadn't crossed the 20-day moving average. That would have been the concerning point for me, is when it dipped below, it's opened below its 20-day or closed the day before, and the MACD was going negative. That's when the RSI kind of started to drop too. But usually 2 of those is the kind of signal for me. Now you can say this has been declining, but it's just been steady. This might have been a marker for me too. I don't know, because it wasn't below the 20-day. I usually tend to focus on those 2. But then again, you say the last time it did this, it sort of came back up, but it didn't close below the lower band before. It just hit off of it. This one closed below, so that might be something to be concerned about in general. Oh, wow, that's funny. I didn't. Someone told me that. I think Ernie told me this, James or Sam. Sam says the new IPO Dropbox is holding at 35% today. Yeah, I used Dropbox 3 times today, but I didn't try to catch the IPO on that one as well. Oh, God, no. I'm sorry. Don't mean to say it that way. Sometimes I always slip and throw that in. James says, am I safer selling bearish vertical spreads than RPMs in these conditions? I'm going to say no. On Monday, you'll have a better idea, James. But what's the risk here? Remember what I talked about before. The risk is that We've seen this decline the past 2 days. We have the weekend to settle it. We have the weekend to digest it. This talk, as Will mentions, about the increased Fed rates and will it affect the row, and we're saying, well, maybe the married puts aren't the best idea. But think about it this way. For next week, so SSOs, the ultra shorts are coming up. Amberell is down to 50. And for just next week, what's my net credit here? 20 cents off of, hate 50-cent strikes. Sorry, let me change this real quick. I don't like the 50-cent strike differences. They drive me nuts. But anyway, let's see if we've got anything that matches our criteria with a 2-point strike difference or more. Looking at the bearish positions. Ugh, that's not attractive. Let me do one more thing. I should have this saved in here. I want a more pronounced bearish trend. I want to see a MACD that's been under at least 3 days. Okay, I'm going to take Lamb Research. Okay, Lamb Research 6 days out. We could do a vertical spread. We could sell the 215 call for $1.58 and buy the 217 for $1. Okay, this would roughly give me a 58-cent net credit, so return of about 30% on a 2-point spread. This is not a recommendation or suggestion. Okay, now same thing. What has happened here? Well, it broke below its 20-day moving average. We see a MACD cross, which we expect to see on all the stocks just because of the last 2 days. It's declined, but 3 days ago it was at 228, 229. Just before that, before there was a little hesitation, it had moved up from 190 to 230. It moved up 40 points in roughly 16 days, 15 days. Okay, so is a bear call spread right now at the 217, 215 a good idea? What happens if the market opens up tomorrow and this is up 6 points? You're at 208. Okay, you're getting close to here. What if it's even more? Fears are settled, and by Monday, everything's back up here, 220. You're at full loss on your spread. Okay, until you see a confirming pattern, James, see what happens on Monday. If things settle down, I'd be hesitate. Sam commented, thankfully, to save me on this one. He says, on Monday, first look at the gaps and then decide which way the market will head before putting your position on, your spreads on, or your other positions. So you want to see, we have to see what happens Monday. Naturally, James, I know you and I can't trade right now after market, but the idea is that I don't think you're safer right now. The last 2 days are not necessarily indicative of where the market is going. It's indicative of what happened to market reaction to the fear of a trade war starting, fear of what could happen with perhaps a budget passing, and fear of what could happen with Fed rate hikes. Over the weekend, are all these fears going to be digested? Is there going to be a new fear? Is there going to be something else along the lines that'll have that? Well, we'll be able to tell when the market opens Monday by 10 o'clock, by 11 o'clock, the gaps, as Sam mentioned, to see what happens. But right now, let me do this. Right now, I'm extraordinarily hesitant to even think of doing a bear call spread on anything. Okay, why? When have we seen a decline like this over a 2 or 3 day period? Well, that's easy. February 5th through February 8th. Okay, so markets here, let's say I do bear call spreads and I'm selling 270s and buying 265s when we're down at selling a 270 and buying a 275 when the market's down here. What would have happened 5 days later, 10 days later, 14 days later? Full loss. Okay, well, little glitch again. We drop down here and another 2-day decline, much smaller than what we just saw. Okay. Well, here I sell a 275 and buy a 280. 3 days later, I'm near full loss on the position. Okay. You can see here they dropped below the Bollinger Bands and closed, and then it wanted to go back up. Drop below and closed, drop below and closed. MACD went negative as it did here, and then it sort of came back up. Let's go 6 months. Oh, sorry, let me get that other one there. And yes, this is just SPY, but I'm using it as a broad indicator. All right, no other major hiccups like this since then. It is getting choppy. Okay, it is getting, because this is more movement than we've probably seen in the last 6 months. Let's go 2 years. You can do it, chart. Okay. Yeah, see this huge kind of decline here. Harder to see. Sort of, kind of, and percentage-wise, kind of happened here. Right, and that was back in 2017. That June, July, fall of 2017 probably dropped down to 200 from 220, almost a 10% decrease, right? I know it's hard to see there. Let me see if I can increase my size of my chart so we can get a better view, folks. Hopefully it doesn't go too big. There we go. Okay, so it's more like 215, right? Now it's 210. Yep. To a low in a 5 to 6 day period of 198. Okay, so it's about a 5% decline roughly there at that point. 10 points, 11 points, 12 points, 6 to 7% decline. Then it went up shortly after that, and then it went up more. Was this a time to do bear call spreads? No. How about here? Not as big as a decline either. 215, dropped down to 209, so it's only 6 points. Not that much, but 3% decline, but it happened in 5 days. Was this a time to do a bear call spread? No. It would have gotten hurt. Here's a little dip that came back up. Now I know you're saying, well, this dip is so much more exaggerated. Well, we've been on such a large run, a correction was necessary, and we had that here, but this was a different scenario. This is a different scenario, but again, who's to say we won't be back up to 280 or 275 come Tuesday or Wednesday? It's hard to gauge, and that's why I'm saying I would not recommend doing a bear call spread right now until you see more of a pronounced trend. And there's other alternatives. Sam says instead of a bear call, trying to pick a direction that the stock's going to stay down here, and your risk is if it moves up, as we've seen historically. He says instead of a bear call or bull put, maybe buy a straddle or strangle. So strangle, he says a straddle, okay, at the money here. So maybe buy a 265, 260, call and put, or the straddle, and then do that a few weeks out. Then in the near term, sell calls based on what direction. If it moves up on Monday, sell puts. If it moves down further on Monday, sell calls. So that's what Sam's saying. Now, you got to watch that more closely. It involves leverage, and it's not a direct one-to-one ratio necessarily. But as I was just saying, credit spread is for flat markets, not trending. And you could also do a longer-term debit spread. But look, this is a time, obviously, for bull put spreads, even with the hiccups in here. I'm not going to say that this is time for a bull put, but I don't think it's definitely not time for a bear call. What do we know going forward? We know we don't know the future on Monday. We're anticipating what's going to happen, but we don't know yet. But next week we'll have more of a signal. Are we still in a position where I might want to take a chance that it's going to swing one direction or the other, or are we in fact bearish, or are we in fact recovering to bullish as we've done in the past? And that's right, because if it's neutral to flat or trending upwards, I want to be in bull spreads then. When it's chaotic like this, I want to take advantage of something that benefits me from the chaos, be a long straddle, long strangle. Okay. Will says you've got a static collar position and the drop in the stock has dropped near the lower put strike, bought back the short call. What are my options now? Is it wise to convert the position into an RPM since the put is at the money? Well, it depends on how much expiration time you have left, Will. If you're just looking 1 or 2 weeks out on the collar, for example, that the put that you have that's now at the money is going to expire soon, you might just want to leave it anyway. Now, I'd leave it to Monday. Of course, we have to, but I mean, I'd leave it till the end of the afternoon on Monday to see what the market does. If it starts to move back up, I'd consider selling another call. If it starts to move back down, I might consider selling the stock and leaving the put open, just as a long put position. Or closing out of the position if the loss is not too much. Why would you convert it to a married put now, Will? You'd only convert it to a married put if you think the market is going to recover. I don't have that answer for you. I've told you that I think that Monday we might see it pop back up as we have, but for how long? 5 days, 10 days, 4 days, 2 days, and then it might decline again. So I'm expecting a bounce, honestly, against this, but we'll have to see, because anything can happen over the weekend, which would force it down lower. So if it continues down, Will, you might just want to exit the position if you have a small loss or manageable loss. You might consider selling the stock and leaving the put open if it looks like the market's continuing down on Monday and something else comes out where everything is still being pushed down. Okay, so now you just have a long put position, but you may have taken a loss on the stock, taken the gain on the call, but now you're trying to take another gain on the put. And then if you convert it to a married put, you're saying to yourself that, well, this didn't work out in the first 20, 15, 14 days, however long your collar was from the initial structure, but you think it's going to return to neutral to bullish to the tune of a gain of 6 to 8 to 10% in the next 3 to 4 to 5 months. And if that's your outlook, then sure, might want to sell that ATM put, buy a further out of time in the money put, and transfer it to a married put position. But if you're still concerned, you don't know which direction it's going to go, wait till Monday, see what happens. Maybe even wait till Tuesday if nothing really magical happens on Monday. And that's what we'll look at as well. All right, so Sam offers his thoughts. He says, last when the market dropped 10%, that's February 5th to February 8th. He says we're now at 8% on the broad-based indexes, and it says it's likely to bounce after the next 2% decline. Yeah, we talked about this back on February 5th, that webinar there, and you can access it on our archives, can't we? Let's see here. That's not it. Requested topics. 13th, that would have been it, right? Yep. So you can take a look at this one, the current state of the market. We opened with a half-hour presentation of the current state of the market on the 8th, February 8th or 9th. It was posted on the 13th. We did about a 20-minute presentation on where we are right now, and this fact that Sam alludes to is that 10 to 15% is a pullback, but when you get to the 30% range, 25 to 30% range, it starts to consider a correction where it might go 50%. So what did we see last time? 10, 12% decline, followed by a rise. Actually, it was 8, 9, 11% decline, and we saw the increase back up. Here we are at 8%. We might see another 2 to 3% decline in the next few days, Monday or Tuesday total, and then see a bounce back. Or, as Sam mentioned, watching the other indicators, the 200-day moving average and more on those guidelines to say, hey, are we actually getting into a position where it's no longer available, okay? Or where it's no longer pullback mode, where we're in correction mode. Then maybe we consider bear call spreads. But again, there's a lot of choppiness. We all remember 2008 and 2009, 2007, 2008, I should say, when we were in a correction, but we were seeing weird days where we would be down 500 or 600 points, and then the next day we'd be up 200. And we'd be down 300 and 400, then up 150. Then we'd be down 500, and the next day you'd be up 150. It was driving spread traders nuts. It was a perfect time, as Sam mentioned, to do a straddle and try to leg in and out of it, but you were doing so many trades, it was ridiculous. But it was also very profitable, but the implied volatility was also ridiculous at that time too. So there's a lot of paying into a lot of high expenses, but selling into a lot of high expenses also. But you set up a structure for a bear call spread, even going 75% probabilities, 3% out of the money, deltas of 0.3 to 0.25 for your strikes. Well, the 500 down day is good. You open your position that day and the market opens up 150. You're probably hitting your trigger point to close that bear call spread. So the choppiness is very difficult for spread traders because they end up hitting their triggers too soon in an attempt to avoid further losses as well. Okay. All right. Well, ladies and gentlemen, I don't see any other questions come in. We are at about 5:57 p.m. Eastern Time. I do want to remind everyone, of course, let me just close some of this out here. I just want to remind everyone, If you haven't done so already, remember you can go to powerop.com at any time. Just put in your first name, last name, and email address. Click Start My Trial Now, and that will give you full access to the 14-day free trial, all of the tools, all the search tools, and the different strategies and analysis tools for 14 days, plus all access to all of the archived webinars we just saw a moment ago also as well. And of course, if you do have any questions at any time, remember you could always give us a call. There we go. You can give us a call at 302-992-7971 during market hours. You can also reach us at support@powerop.com. And of course, those of you who are on the trial or subscribers, remember you can schedule a coaching session at any time. Okay. Yeah, Sam's comment, I'm sorry, I was just reading, it says, prudent investors should not buy stocks now. Agreed. I mean, we might be at a low, but I don't think the low is done. It's going to be hard to gauge, but I'm not buying a new married put position until sometime maybe next week or the following week. I'm also not opening any bull put spreads. Managing my calendar spreads, managing the 2 bull puts I have open, or managed the 2 bull puts I have open, and I've got the married puts that we showed right now. And don't think I'm going to be buying calls on the VIX next week, Sam, because I don't think I'm going to like the expense on it. But Sam's comments, prudent investors should not buy stocks now, and aggressive traders will play the market as it develops. Yeah, and I'm not prudent. I'm prudent, I guess, but yeah, I'm not aggressive, so I'm going to wait to see what the settling is. And by the way, if it does go into a bear market, or I think it's more consistent to a bear market, for the fusion traders at RadioActive Trading, you might see me open a married put on one of those inverse ETFs in the next 3 to 5 days before the break for Easter. Speaking of which, we won't be here next week. We won't have a webinar next week because it'll be Good Friday. The markets will be closed. I believe I'm correct on that. So on March 30th, we won't have a Friday session, but there will be some other news and information coming out to you next week. Via email for Power Options, archived webinars, pre-recorded webinars, new content, and more for you before the Easter break. But we will not have a Friday session next week, of course, as it'll be Good Friday and the markets will be closed. Well, ladies and gentlemen, thank you for your great questions. Thank you for your great commentary today. I hope you all got a lot of good education in today's presentation. Felt like you got some good discussion with the hour and a half we've spent together today. I hope you all have a fantastic weekend, and I hope to see you all soon in the near future for one of our next upcoming presentations as well. So take care, everyone. Have a fantastic weekend. We'll see you soon. Good night.